Microsoft made $101 billion in profit last year. It's growing revenue at nearly 15% a year. Azure is accelerating, and the market is selling it like a business in trouble. That disconnect is either a warning or an opportunity. The stock sits at $389. Invyra's fair value engine puts it at $540, a 28% discount on Microsoft the day before earnings. The forward P/E? 20 times, while its 5-year average is over 32 times. The market hasn't priced Microsoft this cheap in years. Invyra IQ score, 7.9 out of 10. Buy. So what's going on? Why is one of the best businesses on the planet trading like it's broken? And is the market wrong? We've run the numbers. Here are 3 reasons the data says buy before tomorrow's close, and 1 risk that could flip the whole thesis. Let's get into it. First, let's understand why Microsoft is here. The stock peaked earlier this year and has been under pressure ever since. 2 reasons the market has punished it. Number 1, capital expenditures. Microsoft has committed $190 billion in capex for calendar year 2026, almost entirely for AI infrastructure. Investors look at that number and ask, where's the return? Number 2, Copilot. Microsoft's AI assistant currently has around 20 million paid enterprise seats. Sounds large, until you realize Microsoft has over 450 million Microsoft 365 subscribers. That's a penetration rate of less than 5%. The market expected more by now. So the sell-off has a logic to it, but logic and price are 2 different things. And right now, the price is telling a story that Invyra IQ disagrees with. Here are the 3 reasons why. Reason number 1, Microsoft is trading at a historical discount, and the numbers prove it. Microsoft's current forward PE is 20 times. Its 5-year average forward PE is closer to 32 to 33. That is not a small discount. That's the market pricing Microsoft like a company in decline, when the underlying business has never been stronger. Now, let's go to Invyra EV. Fair value, $540.73. Current price, $389.10. That's a 28% discount to intrinsic value. On Invyra IQ, opportunity, the dimension that measures valuation attractiveness, scores 7.4 out of 10. That's not just cheap. That's a wide moat compounder, trading at a meaningful margin of safety. To put that in context, when a company like Microsoft, with its moat, its cash flow, its reinvestment rate, trades at a 28% discount to fair value, the IQ algorithm applies a quality valuation interaction. The math says, this is exactly the kind of company that deserves patient ownership at this price. Reason number 2, the business quality is exceptional, and the market is ignoring it. Here's the number the market keeps glossing over. Microsoft's ROIC is 24.9%. Its cost of capital is 8.1%. That gap of nearly 17 percentage points is what we call value creation. Every dollar Microsoft puts to work is returning almost 3 times what investors require. The $190 billion capex, that's not money disappearing into a black hole. That's money going into the machine that's generating Azure's 40% growth rate. Invyra IQ scores the business 9.1 on efficiency and 9.2 on durability. A wide moat rated 8.6 out of 10. These aren't vanity metrics. They reflect a company with pricing power, switching costs, and ecosystem lock-in that competitors can't replicate. And the underlying numbers back it up. $281.7 billion in revenue, growing at 15% a year. $71.6 billion in free cash flow. A net margin of 36%, meaning for every dollar of revenue, Microsoft keeps 36 cents as profit. The market is worried about the capex. The data says the capex is working. Analysts see it too. EPS is projected to reach $33 by 2030, an 18% CAGR from here. You don't get that kind of growth from a business that's broken. You get it from a business that's compounding. Wide moat, 9.2 durability, Azure at 40%. You don't get many opportunities to buy this at 20 times earnings. Reason number 3, the fear is already priced in, which means earnings surprise has asymmetric upside. When a stock trades below its 50-day moving average of $398 and its 200-day moving average of $435, while the broader market is near all-time highs, the bad news is in the price. The market has already priced capex concerns. It has already discounted Copilot disappointment. It has already assigned Microsoft a multiple consistent with a business growing at 10%, not 14%. What happens when earnings come in and Azure grows at 40%? What happens when EPS beats at $4.24, up 16% year over year, and management reaffirms the AI monetization path? Negative sentiment is a coiled spring. The same mechanism that sent the stock below its moving averages can send it up sharply on a single strong print. Invyra IQ gives Microsoft a 7.9 out of 10, a buy signal. That score reflects three converging signals: exceptional business quality, attractive valuation, and positive momentum. When all three align on a wide moat company, the historical base rate for long-term outperformance is high. One note worth being transparent about: Invyra's short-term trading signal, Prism, is currently hold. Technically, the stock is in a downtrend. Direction is bearish. If you're looking to trade the next 2 weeks, this is not your setup. But IQ and Prism measure different things. Prism reads price momentum. IQ reads business quality and value. Right now, they're telling different stories. And for long-term investors, IQ is the signal that matters. The one risk FY 2027 capex guidance could shock the market. Now, here's where I have to be honest with you, because a buy thesis without a risk disclosure is just a pitch, not analysis. The single biggest risk this earnings report is not the Q4 numbers, it's the FY 2027 guidance. Microsoft is expected to disclose Q4 capital expenditures exceeding $40 billion, with full fiscal year 2026 pacing above $100 billion. And analysts expect FY 2027 capex to come in 20 to 30% higher. That would put Microsoft's annual AI infrastructure spend at $220 billion or more. We saw what happened to Alphabet last week. Revenue beat, cloud grew 54%, but the capex guidance sent the stock down sharply. If Microsoft guides $220 billion for fiscal year 2027 without pairing it with strong Azure acceleration and clear monetization signals, the market will sell first and ask questions later. Invyra IQ's clarity score for Microsoft is 6.7 out of 10, the weakest dimension in the profile, reflecting genuine uncertainty around AI spend visibility. This is a real risk. Position accordingly. So here's the full Invyra IQ picture on Microsoft heading into July 29th. IQ score 7.9 over 10 implies buy. Fair value $540.73. Current price $389.10. 28% undervalued. Efficiency 9.1. Durability 9.2. Opportunity 7.4. Resilience 7.2. FWD, PE 20.0, ROIC 24.9%, WACC 8.1%, moat, wide, 8.6 over 10, revenue $281.7 billion, plus 14.9% year over year, net income $101.8 billion, FCF $71.6 billion. 3 reasons to buy: historical valuation discount, exceptional business quality, and asymmetric upside from negative sentiment already priced in. 1 risk to watch: FY 2027 capex guidance language on Wednesday night. This is not a trade. This is a long-term position in a wide moat compounder at a 28% discount to fair value. For patient investors, that is a rare setup. If you want to run the same analysis on any stock in your portfolio, fair value, IQ score, all 6 dimensions, Invyra is free right now. Link in the description, invyra.thinkrium.ai. If this was useful, subscribe. We break down the market this way every week, data first, no noise, and we'll be back after tomorrow's close with the full Microsoft earnings reaction. See you then.